82% of business failures are linked to poor cash flow management. Most of these companies are profitable on paper, yet they collapse because they cannot meet their immediate obligations. Profit is an accounting metric, but cash is a timing reality. There is often a significant delay between the moment you record a sale and the moment that money actually clears your bank account. We define this delay as the cash flow gap. It represents the exact number of days your business must fund its own operations out of pocket before customer payments arrive to replenish your accounts. Today, you will learn to calculate your exact gap and implement the operational shifts required to close it. To follow this tutorial, you need 3 documents: your recent balance sheet, an income statement, and an accounts receivable aging report. Identifying this unseen gap is the only way to protect a profitable company from a sudden, catastrophic bankruptcy triggered by a simple timing mismatch. We analyze this timeline using days outstanding, a standardized way to measure how long your capital remains frozen in different stages of the business cycle. Step 1 is calculating days sales outstanding, or DSO. It measures the average days it takes to collect payment after a sale. By dividing $120,000 in receivables by $3,288 in daily sales, we find a DSO of 36.5 days. When calculating your own DSO, ignore your stated invoice terms. Use your actual historical collection data, as customers often pay much later than the net 30 window on your contract. Step 2 is calculating days inventory outstanding, or DIO. This metric tracks how many days your inventory sits in the warehouse before being sold. Dividing $80,000 in inventory by a $2,192 daily cost of goods sold results in another 36.5 days. Be careful to exclude dead or obsolete stock from this calculation. Including inventory that will never sell will artificially inflate your DIO and give you an inaccurate view of your cash health. Step 3 is calculating days payable outstanding, or DPO. This shows how long you take to pay your own creditors. By dividing $60,000 in payables by $2,000 in daily purchases, we arrive at 30 days. These 3 numbers map the hidden timeline of your business, revealing exactly where your money is trapped and when it will finally be released. Step 4 is finding your total cash flow gap. You add your DSO and DIO together, then subtract your DPO. For this business, that math, 36.5 plus 36.5 minus 30, results in a 43-day gap. This means the business must have enough cash on hand to fund 43 full days of operations before the revenue from those operations actually arrives. A positive result means you need external working capital to bridge the wait. A negative result is the ideal state. It means your suppliers are effectively financing your growth by giving you longer to pay than it takes you to collect. To move toward that ideal negative gap, we now enter Step 5, actively adjusting the variables of the formula. You can lower your DSO by offering a 2% discount for payments made within 10 days. This small concession often pays for itself by accelerating your cash inflows significantly. You can reduce your DIO by moving toward just-in-time inventory. Just-in-time is a management strategy that aligns raw material orders directly with production schedules to minimize on-hand stock. And finally, you can strategically increase your DPO. Longer vendor payment terms keep cash in your accounts, providing a natural buffer against your late-paying customers. When you systematically address these 3 areas, you stop reacting to billing cycles and begin dictating the terms of your own working capital. Look at our case study's transformation. By renegotiating terms and optimizing inventory, their 45-day gap became a negative 5-day gap. This timing shift unlocked $1.8 million in liquidity, funding a 30% expansion using their own money instead of new debt. As you plan your own targets, build a 15 to 20% buffer into your gap calculation. This margin of safety protects you from seasonal dips or unexpected supplier delays. Remember that a single calculation is a snapshot, not a permanent state. Track your gap using rolling averages to ensure seasonal sales spikes don't hide emerging liquidity problems. Most modern accounting platforms can automate these calculations. Set up a real-time dashboard so you can monitor your cash timeline as easily as you monitor your sales. Mastering the cash flow gap moves a business from a defensive struggle for survival into an offensive powerhouse, fueled by its own operational efficiency.